Good evening, everyone. This is Rodney with the Triton Wave Market Outlook for Wednesday, July 17th, 2013. And this is brought to you by my company, Triton Wave Consulting, which are early warning market timing indicators that are used all over the world in any time frame in any market. I am also including gold in this update because it's been a few days since I've done, it's been about 10 days since I've done a video. So I took a little time off, so I'm including gold for those of you that have gold. All right, let's first take a look at the ES. Last time I did this video, we were right around this point right here. We were right here. I thought this was going to hold because all these were below zero, and in fact it didn't. And I got very disappointed. Didn't work out my way, but that's trading. I got rid of everything. So I did not play this because I just don't like this market. I think it's overbought. I think it's a 1999 balloon like the high tech boom. And I wanted to show you something that happened the last time the market was in this kind of shape. First, I wanted to show you. Okay, so this high, higher high, higher high. I've been talking about this since last September. Lower high on the waves, lower high, and this is so low that it has not even gotten back above zero on T1, which is the first trading wave. However, we are in fact at a double top right here. Oh, let me move that. Let me try that again. Right. Okay, we're at a double top right there. So this is a nice higher wave. This is a much lower wave. The same you can say for T1, T2, T3, and this little blip above. T4 is the same. T5 is well above zero, so you really can't use that as a measure. All right, what I wanted to bring in was a graph of. Let me see if I can find it here. A graph of the Aussie dollar. So the Aussie, let me get a pen here. Okay, so this is actually a live chart. The Aussie dollar is in this thick candle, and the SPYs are in the thin candle. All right, so I'm going to take off the arrows because I wanted to go back and show you how consistent this has been for the last 5 years or 6 years, since 2007. You can see there. Let's go back to 2008. Okay, everything has been pretty much in lockstep. Whether the Aussie yen is following, you know, how this goes down here, this goes down here, this goes up here, this goes up here. They've been in lockstep. As you move the graph around, they're almost in total sync. You can see how that's moving. Okay, when we had that big move down in March of last year on the Aussie yen, we had this move down here. Not as precipitous on the SPY as it was on the Aussie yen, and that's why the SPY held, and that's why the Aussie yen snapped back up. But then it moved up and down in here in sync, and pretty much all the way through. Okay, two big spots that I wanted to point out was, we move this here. You can see I'm gonna put this in let me see, color red here. Let's make this a red. Okay, this big area here is when the Aussie yen was moving kind of to the right. Let me change that color a little bit again. Hang on. When the Aussie yen was moving sideways and the SPYs were moving up, the Aussie yen, the SPYs eventually caught up with what was going on. And in a lot of cases, because the Aussie yen is a risk on, risk off indicator that's been pretty much in sync for years. When it goes out of sync, there has to be an alarm set off in your head. So we have the S&P going up, and we have this going sideways. So what happens is that they come down and they meet each other. This area in here, from here to here, was a 120-point move on the S&Ps, which is equivalent to 1,200 points. That happened in August, September, October of last year. All right. So what do we have here? We have the Aussie yen moving down, and we have the S&Ps that have gone either sideways, down, or up, hit almost, I don't know if the SPYs hit a new high, but the Dow certainly did. So we have the same situation here. Now, in order to reconcile that difference, because they've been in sync for such a long time, you either have this moving, as this moves up a little bit and this moves down a little bit. You could have the same. I'm looking for that same kind of that same kind of meeting right in here. And there's no reason why it should not happen. The timing is perfect on it right here. We're at a new high on like a double top here, and that's what I'm looking for. I'm looking for a move down that's going to surprise everyone, just like it surprised everyone right in here. All right, that's done. Let's get rid of that. Now let's go back to the S&Ps. Now where does that take us on the S&Ps? On the S&Ps, it takes us to, I think I have to change this color back because we're not going to be able to see it. Hang on 1 second, yellow. Okay, so that takes us down, if it indeed is 120 to 140 points on the S&P, that takes us down to about 1530, 1540, which puts us in this area right in here, this white line that I drew, and that takes us down into this area. And this is going to be a total surprise. This takes us right into the 233 exponential moving average, which if you look back here and if you look back here, this is exactly what happened last October. So the timing's right for it, the amplitude is right for it, and do not be surprised. I know everybody's looking for a 1272 extension or 1618 extension, and you know that may happen. Who knows? Bernanke's going to speak tomorrow, and it may scare the hell out of the market. All right, let's take a look at gold. Gold, where are you? Gold electronics spot. All right, so I have a story about gold. I've been reading Malden Economics, put out by John Malden. You can, it's a free sign up. He puts out a letter every week, and this is kind of like a distillation of what he's been talking about. Let me get those lines out a little bit more. While you're looking at this, this is also a live chart. We're up 690, and it looks like, you know, I had gold when it did its reverse candle yesterday. I thought it was going to come down here and touch 1261, and then it did a reversal in the middle of the night, and now it's just kind of hanging right out at the 21 period moving average. So this is a story of gold that I got from, this is a distillation of information from Malden Economics. and that is that when gold was selling for its, I don't know if I have the history that goes back all this way, but yeah, I do. Okay. So at this point, Chavez from Argentina decided that he wanted all of his gold back from wherever he had it warehoused in the world, and that was half in London and half in New York. He's got 300,000 tons of it, or maybe, I don't know if that number's right, hang on. Sorry, my faux pas, 300 tons of it. I knew that 300,000 tons was a lot, maybe 300,000 pounds. 300 tons of gold sitting in London. So Argentina has 300 tons of gold sitting in London, and they decided they wanted all their gold back for whatever reason. They want it closer to home. So they made arrangements with the banks. Of course, the banks, turns out, could not give them all of their gold right away because they can't even ship it on 777 Boeing 777 planes fast enough because there's an insurance limit on how much you can send at one time. So they worked out a 7-year plan, and the reason why they worked out a 7-year plan, as far as I can understand this, is that a lot of the gold that's being held in London and New York and is being loaned out for a fee to different banks that in turn want to invest money in it and using gold as a backup. So basically it's kind of like a carry trade. So because gold is nice and steady, even though it's been going up, it's steady. So when somebody like Argentina comes along, and now Germany is doing the same thing, and I'll show you on this graph where this is happening. Germany also wants money back in. They want more control over it instead of, they want it in their own doorstep rather than somebody else's doorstep. Now, why would you do that unless you saw something really bad happening? Because if everything goes along copacetically, you don't need to do that. But if you see something happening in the world that makes you think that things are not the way they should be, you're going to be defensive about it, and you're going to take everything, you're going to bring everything back home. So that being said, there were smaller holders with only instead of 300 tons, they had, like $1 million worth, $2 million worth, $3 million worth. So they go to the Bank of England that's holding their gold, and they're from the United States, and it ends up being held, held in under the bank, under the vaults. I'm sorry, in the vaults under, under street level, under high security. They present all the papers that they need, and the bank says, we don't have the gold to give you, we're going to have to cash you out. So in other words, they would not give them the gold, because giving them the gold meant that all the gold that they have sitting in the BOE, Bank of England, about 30% of it being loaned out to other central banks all over the world for them to do whatever they want, because they get paid to loan it out. In fact, one country made 300 million euros loaning out gold over a 7 to 10 year period. So they take this gold. If they were to give the gold back to everyone that wanted it, they would have to take it back from all of the people that they've loaned the gold to. And that can't happen all at once. That has to be like a very, very slow bleed. It can't, if it happens all at once, it's like yelling fire in a movie theater. You can't unwind all those positions at once, because some of them are deeply invested in equities all over the world, or in housing, or in land developments, and you can't pull it. So they gave them cash, which is in reality a confiscation of that person's gold and they just gave him a cash settlement. So that's what's going on in the gold market. So as a result, this is what happened in those two periods. This is the Argentinian demand for their gold from for back to their own country, and this is Germany's demand right here. So you can see as since the Argentinian demand, boom, it went down, and boom, it went down. So the message here that I see is that we are in, the only reason gold has been going up all these years is because we've been having inflation. The only reason gold goes down is because we're deflationary, or the anticipation of deflationary. So no one wants their gold back if they think everything's working, operating well in the economy. Nobody wants their gold back. It just sits there and everybody's happy. But if they see something that they don't like, which to me is deflationary, they want their money back. Okay, so at the same time, the bond market is going down precipitously, which is sending interest rates higher. That's inflationary. And at the same time, the dollar is working its way up, because that's what happens when that's what happens when deflation happens. Everybody wants to get in the dollar. It happened all throughout the Depression. The dollar was king. So in juxtaposed to all this is Bernanke coming out and saying that he wants to keep the interest rates very, very low. So he's not doing anybody a favor. The reason why he wants to keep interest rates low is because there are a lot of there are a lot of Social Security payments for coming due, especially baby boomers. You know, by I don't know, 5,000, 10,000 a day, turning 65, getting payments. And there's 14 to 17 trillion dollars in debt that he does not want to pay back with higher interest rates. So his vested interest is to keep interest rates very, very low, near zero. The bond market knows that's not going to happen, and it's tanking so that the bonds are going down, interest rates are going up. So you have, on one hand, gold is saying deflation, the bonds are saying inflation, and this going up, and the dollar saying, protect me, I need to get the hell out of here, which is deflationary. So very, very, very mixed messages here. So the more confusing it is, and the more delicate the balance is, the more fear there is going to be in this market, and that's why I think we are due for a correction very, very shortly. All right, let's take a look and see some of these stocks here. Let's look at Apple here. Okay, Apple's kind of waffling. It was up a little bit today, but it's waffling. It may, okay, the 8 and the 21 crossed, then it crossed the 55. So before it's over, it might go up another 5, 6, 7 points. It might even go up to this exponential moving average up here, right around 438. Let's look at the 21 and see if that's any help. Let's get this on. Get that out of the way there. Time templates, day only. Okay, I can't really see anything with the 21. It looks like the same. A immediate target is only 2 points away. It's 432, but it might sail on past there to this old high up here. Once it gets past here, it looks like a 430 to a 439 to 440 area. All right, Goldman Sachs. Some of these things just like completely took off. Okay, when I was looking at this last week, Goldman was buried right in here. Was buried in here somewhere, and then this happened, and it never looked back. Boom, and then this happened. So it took a ride of like 13 points. Did come down a little bit today. Some interesting stocks that I wanted to look at. Not that I participated in them, but they're always fun to watch. TSLA. Tesla. Okay, so if we look at a daily on Tesla, no, it didn't go back that far because it only started like July 10th, July 2010. Okay, Tesla, at one point, I remember warning you that this was like a parabolic, like a parabolic curve, and it wasn't going to last. Well, it did come down 116 to 92 and then take off again. But my target for it was in this, let me see here. My target for it was in this area in here. So, okay, this is what I completely missed because I wasn't watching it. Was that, and it did have a little bit of help from Goldman Sachs, because Goldman Sachs came out and they said they changed their target price from 55 to 89 or something, and it's all the way up to 133. So that didn't help Tesla. Okay, so yesterday right here, this is when the 21 on the 21-minute chart on Tesla right here went below zero, right at this point right here. Okay, so it was actually selling for 127. And if you're playing these, you know, like if you're playing it here or here, they're fairly accurate. Get nice runs all the way up here. All right, I wasn't looking for it. I didn't see it. I completely missed it. And just so that you know, I like to see how. Let me see if I can put this up here. Okay, so for those of you who like to speculate, the one with 4 days left, the 120s, the one. Let me see here. Hang on 1 second. Tesla. The 120 puts. So these puts right here were selling for 67 cents, right at this level. Okay, they were up 1,200%. These puts that were the 15s, right in here, were selling for 18 cents and ended up at $7.40. And that was a 4,000% move. And for those of you gutsy enough, and if you saw this and you wanted to play it, for the 110s, they actually moved from 2 cents to $4. It was a 20,000% move. Great day for all of you who are like extreme speculators. But you know, even playing it conservatively, you could have done very well. Even buying you know, like 70 deltas, you know, like up here at like 130, 135, you would have scored big. Okay, that's all I have. A little perhaps erudite tonight, but it gave you a bigger picture of what's going on with the market and gold and how I see things, my perspective of it. So again, I am Rodney Julian, and this is I am Triton Wave Consulting. And if you would like to participate in, I have a consulting service that will shoot out emails or text messages whenever I see changes going on in the market that need your immediate attention. And I look at this like more than really ridiculously long hours, like 10 to 12 hours a day. So I'm doing plays in the middle of the night as well as during the daytime. Have a good evening, and I will see you at the next update.